Hello, this is Janice Penny. Um, I this is the rent versus own analysis of a personal residence, and this is using as you can see, the purchase price of the home as $250,000. The initial rent is $1,600 for the house in question, or the rental in question. The rental is with a 3% growth rate. The property is with a 3% growth rate as well per year. And insurance is $1,000 for the home. Maintenance is $2,500. And an expense growth rate of 3%, marginal tax rate of 28%, and property tax of 2%, with selling expenses at 7%. And the loan value is 80% of the purchase price. The loan amount is $200,000, and I did that calculation by just taking the 250 and multiplying it by 0.80, which gives us a loan amount of $200,000 with an interest rate of 5% and a loan term of 30 years, with a payment, 12 payments per year. The annual debt service. So with that, with taking the loan amount, which is the present value, and the interest rate of 5%, and dividing that by 12, and then taking your, which is your interest rate, and then your loan term is 30 times the 12, which is your N, or your how many payments per year. I think that I'm saying that right. And that came out to be the actual, and then you calculate it to get your payment. And the payment was $12,883.72 per year. And then the annual loan constant is 6.44%, and the equity investment in the home is $50,000, and that is just the $200,000. You only took the loan out for $200,000, and you paid down the $50,000. Then this is the summary of the loan schedule. So at the end of year one, you've made a total of the $12,883.72, which is right here as well. But you made that each year. And that gives you a balance here of what you've paid, or the balance on the loan, which is, you would think that, it would take it down $12,883, but it doesn't. You only reduce the loan amount by the principal, right here, the principal payment. The rest was interest. And initially you pay more interest on the mortgage, and gradually you pay less and less, which takes a while, but it does go down. So you take the $200,000 minus the $2,950.73, and that gives you a balance of $197,094.27, and the same. So each year, that interest rate, the amount of interest, yes, as you can see, continues to go down per year. And then your property data in year one, with inception of the loan, you have $250,000, and the value goes up. As you can see, you're using this calculation. The value, let's see here, the property tax margin, that's expense growth, yeah, 3%. Property growth rate is 3%. So that's just taking the $250,000 times 3%, which is the $257.50, and then taking that times 3% for the following year, which gives you an increase, of course, of 3% per year. And then on rent goes up as well each year. And from here, let's see here, what did I do? It goes up as well each year by 3%, and you just basically take your $19,200, multiply it by 0.03%, and then you get this number for the second year, and then you multiply that number by the 3%. And yes, I did do all of this because every time I did a formula, it would give me an error message. So I just calculated everything and did it by hand, which took me 6, 7, 8 hours in the end. But anyway, property tax as well increased. Let's see, with that you have a 3% increase because you have an expense increase of 3% per year. Yes, expense growth rate. So you do the same thing. Your initial property tax is $5,000, which that $5,000 was taken from property tax of 2% on $200,000, and then which is $5,000, and then each year you increase it by 3% based on whatever the current property tax number was. So the 5150 was multiplied by 0.03 to get this number, and then this number was multiplied by the 3% again. Interest, tax deductions for owning. Did I go past property tax? Insurance, I think I skipped down. Insurance was $1,000, and then of course it went up 3% here. Maintenance was $2,500, and then it increased 3% per year as well. Your principal and interest it stays the same. That loan was locked in, a fixed rate, and then your total cash outflows before taxes with the calculation of all for these items to get this 21. And then of course, as you well know, it's going to increase these numbers with the increase with the 3% per year. This number of course does not. Which gives you, after 5 years, total cash outflows of $22,450.56. Then also, there's a tax deductions from owning. You have your property taxes, and here are your increases again. Your interest, here's your total interest is a deduction on your taxes. And then, of course, it increased. Exact number on the increase of that was and then total tax deductions. This was your total tax deductions. between the $5,000 and the $9,932. So you had a total tax deductions of $14,932.99 for the first year. And to get the tax savings, you multiply that by this 28%, your marginal tax rate. So 0.21 to get tax deductions. Yeah, to get your $4,184.74. And then, of course, as your years go on, calculate the same way. Net cost of owning, cash outflows before taxes are right here. So I took these numbers the whole way across and then put those right here. Cash outflows before taxes. So I just copied and pasted those from the calculations that I had already created. And then a tax savings, which are all these numbers across, for total tax savings. It's right here as I copied and pasted these from this calculation. And then net cost of renting this was the first year, then $19,200, and it increased by 3% each year. And then you have a cost of renting, which is here, which is just these numbers right here where we already calculated how much it was going to cost to rent. And then the cost of owning, which is this amount, the after-tax cost of renting, which gives you an after-tax cash flow own versus rent of $1,997.72 the first year, which is less than the cost of renting, of course, because you have the deductions, and then you actually own something in the end as well. So the before tax cash flow sales price was $257.50, and that came from right here, the $257.50 up right here, the property values right there, the selling cost, which is 7% times this number the whole way across. You just multiply 0.07 to get this number. And then the mortgage balance, which is this balance, again, is not what you would not take off the full amount of your payments per year. You would only deduct, or you would only subtract the interest or the principal payment that you made, not the interest, because interest does not reduce your principal, or interest payments do not reduce your principal. And then the benefits from sell to own, rent. The first year is $42,380 overall. And then, of course, it increases each year. When your mortgage balance goes down, your selling cost go up, and then your sales price goes up. Your house is worth more and lots of times it's worth more than 3% as well. And then after-tax cash flow sale, your sales price is, these numbers come from up there where I previously calculated, less the selling cost, which is this amount, which is the 7% of the cost, less the purchase price, which is the $250,000 that the house was purchased for originally, and then the gain on sale. Here's the gain on sale.